Hey, welcome back to the channel. My name is Alex, and in this channel, we document the growth of a $100,000 account I've created for my newborn son. We're growing the account using technical analysis, fundamental analysis, and some news. And in this episode, we're going to go over the progress of the portfolio, how much we're up, how much we're down, all the positions, some news items that have happened this week and today specifically, and also my market monitor that helps my investing process. So if that's something you're into, stick around. All right, so with every video, we like to start with some news items. And today we got a slew of them. Trump calls today's jobs numbers rigged to make Republicans look bad. And he ties it back to a massive downgrade revision of the 818,000 jobs right after the 2024 election on November 15th. He blasts it as a total scam and dings Fed Chair Jerome Powell, too late Powell, but ends on a high note saying the country's doing great. Now, what's the deal here? Trump is referring to a real revision by the Bureau of Labor Statistics. Back in August 2024, the BLS announced a preliminary downward adjustment of 818,000 jobs for the period ending in March 2024. So basically, the economy added fewer jobs than initially reported. This slashed the yearly job growth from about 2.9 million to 2.1 million. So fact checkers like factcheck.org call this a routine annual benchmark process, not some election time conspiracy. It's based on more complete data from the state unemployment records. But critics on the right, like the House Budget Committee Republicans, argued it shows the Biden-era numbers were overhyped by 28%. Either way, it's fueling recession fears, especially with the recent weak reports. Trump sees it as a political sabotage. So moving on to the next post, Trump says he's just learned that the job numbers are produced by a Biden appointee, Dr. Erica McEntfer, Commissioner of the Labor Statistics. He accuses her of faking numbers to boost Kamala Harris's chances before the election, claims overstatements of 818,000 jobs in March 2024 or more later, and ordered his team to fire her immediately upon taking office. He calls for more accurate numbers, saying the economy is booming under him despite Fed games, and throws shade at Powell again. The next thing Trump said today, he said a lot of stuff, but he said basically, based on a highly provocative statement from the former Russian president, Dmitry Medvedev, now deputy chairman of Russia's Security Council, he ordered 2 nuclear submarines to be positioned in appropriate regions. He warns that the words can lead to unintended consequences and hopes it does not escalate. And throughout all of this, Trump is just continues to tweet at Jerome Powell, dubbing him, too late Powell, a disaster for being too little too late, and yells, drop the rates. But he says, tariffs are bringing in billions for the United States. And the little background, the Fed just held rates steady on Wednesday at 4.5% for the 5th meeting, defying Trump's public pressure for cuts. And Reuters and NPR report Powell citing inflation risks for Trump's trade policies as a reason to hold firm. So on tariffs, CNN says they've netted about $150 billion in revenue since Trump took office, with July 2025 breaking records. But economists at the Tax Foundation warn they raise costs for Americans and could add $17 billion in taxes this year alone. Trump loves them for fun in the government, and detractors say that the consumers pay the price. So with that, let's move on to the market monitor and see what's going on. All right, so for those of you who are new to the channel, the market monitor is a collection of data I've taken over time. It tracks the position of stocks and also certain breadth metrics and correlation metrics in the market, and it helps me time my moves a little bit better and prepare for future moves. So with that, if you guys are curious about how the market monitor works, I've linked a video in the description that describes every column. I'd refer to that video to check it out if you want to know what I'm talking about here. But essentially, we are market monitor red. Oh, and if I'm going to post a little image here that describes the cycle analysis going forward in every video. So you just pop it right there. Basically, markets move in cycles from rally attempt to rally under pressure, and then of course to a pullback or a decline. And I have to, I think I had my charts wrong and it was showing a decline of 2.33. It's actually only a decline of 1.63. So I'm going to put this at before the market monitor segment because I was given wrong numbers. So I'm going to change the background, but it's still going to say, I'm going to still be talking about the minus 2.3. So just ignore that going forward. Yeah, the market monitor is currently red. We are day one red. And so far in this wave or in this cycle, we've gone down, or today's move is negative 2.33%. And the average red cycle lasts about 6.4 days and it moves negative 2.13%. And our distribution count is full, which means we're in a red cycle. So with that, I mean, essentially it's telling us that the start of this red cycle is a very powerful one. We've got basically a 2.3% move already on day one. And typically day one red cycles are always the worst day. So it's interesting that we've already moved greater than an average red cycle. So that could lead to more strength, just like we've seen on the last green cycle and the last yellow cycle. But that's just something interesting to note that we're already above average. Yeah, so with that, let's move on to some internals. And wow, there's a lot of things that were pointing to this market kind of turning over here. Yeah, as you can see here, the VIX basically, spiked to 20. We are now below the 21 moving average and the 10-day moving average. You can see here on the left. And then the correlation index just doubled. It went from 11 to 20. So a lot of stocks are going to be moving together now. Yeah, very interesting there. And then, I mean, the main interesting thing and you'll see it in the portfolio report as I go, later on in the video. If you look at this bear C column and lower low column, I mean, basically for the last 2 weeks, it's just been a madness of selling. There's just been selling every day, even with the indexes moving higher. They were selling a lot, going into these last 2 weeks. And it was frustrating for someone like me who had puts on the QQQ, and calls on the VIX to see the index keep rising. But then my portfolio makeup is basically small caps or smaller caps. I mean, I do have Tesla and some big cap stocks, but essentially it was just getting hit. And you're going to see it in the portfolio later. Just massive selling as the index goes higher. But we held on to it, and now the puts paid out, or they're paying out right now. So that was just very interesting, and that preceded this decline today, because the breadth always kind of precedes a decline in the index. So with that, let's move on to the stage analysis so you guys can see as well. Yeah, so we have 9% of stocks in stage 1, 40% of stocks in stage 2, 14% of stocks in stage 3, and 36% of stocks in stage 4, and we've moved into market cycle red. And yeah, I've been saying this for the last 3 weeks, where the breadth has just been bad, and the index has kept going higher. But now, I mean, it's pretty apparent, now 40% of stocks in stage 2 and almost 40% of stocks in stage 4. So it's definitely bearish market indeed. All right, now moving on to stock overbought and oversold indicators on my market monitor. Number of stocks above and below the 45-day Bollinger Bands. We're starting to get a pickup in the numbers here, 164. Also, I mean, you can see this 5% R column. I mean, the last 2 weeks, there's just been massive amount of selling and buying, but mostly selling. And then also the short-term momentum down indicator. We flipped from a green wave down to a red wave. We're at 410. So, we could bounce here because it's getting pretty extreme. But also, if you look at this TD buy column, which is a oversold indicator, I love to use. It works great. Okay, if this thing gets to 1,000, the market's going to bounce. It's only at 300, so it's interesting. We're oversold in some indicators, but then not in others. And then the anxiety index, we were very docile going into today at 20,000. And then the 63P, or basically stage 2 stocks plus stage 1 stocks, is back at 50%. We saw this massive decline the last few days. Basically from the Fed day was the bad day. And this is something that's really kind of worrying me here. where we have the long-term breadth is at 5. So essentially, whenever this thing goes negative, that keys a bear market. And then what I want to show you guys later on in the video, in the TA portion of the video, is, I mean, maybe it's going to go into a bear market here. And this was the last hurrah. And we go back down to the April lows here. Because, I mean, this indicator only goes red when we're about to enter a bear market. And the fact that we're basically at all-time highs and this thing is about to turn red, it's just very interesting. So with that, let's go on to the portfolio update and see how we're doing. All right, so if you guys have made it this far in the video, I really want to thank you guys. Really appreciate everybody who's watching. I mean, we've slowly kind of grown this account, and just appreciate all the people who comment and who like the videos. Really want to thank you guys. And yeah, if you guys like what you're seeing, if you want to smash that like button, or leave a comment, I'd really appreciate it. Thanks. All right, so portfolio sits at 108,800, and it was down 1.48% today, or $1,600. And as you can see below here, this is the portfolio versus the S&P 500, and as you can see, we've been kind of just getting slammed here this last week and a half. We had this nice uptrend, this nice equity curve, and then basically in the last week and a half or so, things have just started to fall apart and really crash. I mean, we had puts and we had some VIX calls, but and we have calls sold on a lot of the stocks. I mean, not all of them, but a decent amount of them. But yeah, we still, are getting hit here, which is, common, because we do have protection down to a certain level, and we got the puts. So, after it goes down, like basically around here, it will stop going down as severely because we have tail risk protection. That's kind of how this works. But yeah, just, we were up in July. We had a good July, decent July of 2.3%, as you could see here. And maybe what I could show you guys is kind of what I was doing this month, what the holdings are, and yeah, just how diversified we are and kind of how we're ready to go into this kind of bearish phase. Yeah, because we get some protection and we're fairly diversified. But yeah, our weekly performance here was pretty abysmal. We were down almost 5% over this week. So pretty bad week. And Friday or today was, the brunt of that. I mean, even though, I think on the Fed day and other things, we were getting hit a little hard as well. But yeah, so as you can see here, I mean, we're pretty diversified. Majority of the portfolio is this bond stuff, which is going to protect us on the downside. And, Tesla didn't do too bad today. We get some Chinese stuff. And one of the good stocks has actually been this FTAI, this Fortress Transportation. But yeah, the portfolio remains decently diversified. We're going into this decline in good shape. So as you can see here, this is kind of the heat map of the portfolio, and man, you could really see how much different assets got hit and the size of these assets are in the portfolio. So of course, like the largest things in the portfolio are the bonds, and they're basically flat or up. But a lot of things, I mean, we're down, over 10%. I mean, I every time I these tiny little positions of like point something, every time I start like buying, funny things like meme stocks and stuff, the top's about to come. So very soon. So, interesting to note that the consumer staples did pretty decently. The bonds did decently. The auto parts are doing well. The utility funds are doing well. Most of these income funds, I mean, they're pretty much, they follow the market, so they're going to go down. But we got hit pretty hard with, a lot of these speculative names, right? So like the Ethereum stuff, the solar stuff, the tech stuff. We had INOD, it was up a lot yesterday pre-earnings, but then it dumped like 20% today on earnings, so it's down about 8% this week. Just overall, I mean, everything in the account is pretty much pulling back pretty heavily, except for FTAI. That did really well for us. So with that, let's go into some TA and talk about some of the things I'm interested in, like because we did do some rebalancing. We sold off some of the nuclear stuff, we sold off some other things, and bought more bonds, right? So as the market declines, that's what we're going to do. We're going to start selling off the bonds and buying more of the stocks, and then also we're going to sell off some of the protection and buy more stocks. So yeah, monitor for that. If you guys want to check out every move that I'm making, I put a link in the description of a website, this website here, that tracks every trade. I mean, it doesn't track the options, which is why it's a little messed up. But if you guys want to check out what I'm doing, I think it updates every day or so or something like that. But feel free to come check it out and see what we're doing. Try to be transparent here on the videos. So yeah, go check that out. And so with that, let's go on to some TA. I want to show you guys some of the analogs and potential, maybe this is the top. We're going into a bearish market. So let's check it out. All right. So what you're seeing here is my cycle forecast. So the red is the red cycle and the amount of decline that you should expect. The orange is same thing. That's a future cycle. And also the green is what we should expect on the upside when this pullback is over. So it's making a lot of sense that, the next bounce spot is at this new high on IWV. Just makes a lot of sense. And for the cycle forecast, there's just a lot of confluence. And if this thing kind of, goes over for the next, if I draw a line here, that perhaps could decline here as it approaches it, everything kind of just leans to on expiration day that we're about right here. So this bounce, maybe it goes a little bit stronger because this is, the start of this red cycle is very strong. Maybe it kind of blows past through here, maybe does something like this, but then continues higher like that. So that's kind of what I'm seeing on the IWV in terms of the cycle forecast. So with that, I wanted to show you guys something on the QQQ. All right, so what you're looking at here is the QQQ, or the NASDAQ 100 ETF. And there are a lot of, I'm going to clean it up here. There are a lot of lines here. Actually, these are for my puts and the callers, so I'm going to leave those there. But we could get rid of that green line right there. So, with that, as you could see here, market gap down heavily after this kind of bearish engulfing candle, or whatever you call it, whatever you want to call it, up thrust yesterday. And then we had a pickup in volume, nice spread here, increased to the downside, kind of ended at the low of the day, but we stopped right here at this anchored VWAP from the rally, which is a typical place. And we, as you can see, it wicked perfectly off of that anchored VWAP. If we go intraday here, it was just perfect on that anchored VWAP right here. Oh, no, I'll just go backwards. But yeah, so it wicked right there off the anchored VWAP, which normally is the case. So everybody's going to add to their positions who are long. But if it breaks this, you could expect it to go much lower. One thing I wanted to show you guys is actually on a long-term basis. So we have this kind of range right here that I drew. That was my expectation for where we could decline to. So I think that's right around 540 on the QQQ. But this is something interesting that I think is kind of hidden here, that nobody was, I haven't heard anybody talk about this, but essentially there's kind of like a head and shoulders here. So here's the shoulder here, here's the head here, and here's the shoulder here. And then, of course, it broke the neckline, right? And we had a decline. And this entire rally has basically just gone right back to the neckline. And it's a little tricky because it's a upward sloping head and shoulders, which you typically find in leading indexes and leading stocks. And we're right back here, and we gapped below it, this little range. Okay, so if we see, it goes all the way back to this entire bull market, this little range here, and this neckline, or whatever you want to call it. And also, if you see this indicator I have up here, which is the distance from the yearly moving average, right? We've had successive lower highs. Okay, so if you draw a trend line, okay, from the distance from the yearly moving average, okay, boom, this is the highest one at the beginning of a bull market, right? It's the most momentum at the beginning of the bull market, right? And every new high and decline after that has been a lower high, up thrust here, which is the top of the head, boom, hit it again here, but it's still lower, right? So it shows a general weakening of the trend, right? And so we just made the final high, and it's the weakest high from the distance from the yearly moving average. So that's something interesting. We just see weakness after every successive new high. And that's typically what you see, as you can see it back here in the QQQ right here. This is COVID, how this bear market started, right? We have the highest high from the yearly moving average. Higher is lower, lower, lower. And the last high in a bull market, distance from the yearly moving average, is always around, what is that? 17-ish%, right? And right now, the distance that we peaked was about 15%. So that's just something interesting that I noticed. So potentially, that long-term breadth that I'm seeing on my market monitor is basically confirming perhaps the start of a bear market, right? Or a trip back to the lows, which would form a range, right? Because this would basically be a change of behavior. And then this is the rally, and a strong rally because we made a new high. But if we're going to range here, right, basically create like a giant, new range, like say here and here, as a new trading range, similar to this market right here, that would be my guess of that's just, I'm laying out the case. That's the thesis, at least. Okay. So with that, I don't want to get into any specifics of stocks. There's some stocks that we could talk about that are very strong, like FTAI is a very strong stock. But I typically do that on other videos. But I just wanted to show you guys the cues today, show you guys the account. We're hanging in there, and I think next week's going to be a great week. I hope you guys have a great weekend and enjoy your weekend. Have a good one. Oh, and if you guys like the content, if you guys like the video, please feel free to subscribe and hit that like button and leave a comment. I'd love to hear from you. All right, cheers.